David Stevens highlighted 5 reasons mortgage rates will rise in 2020. It's a really good article, and David is really, really smart and an industry veteran, so I try to soak up all of his content. We wanted to have him on today's show, but it just didn't work out. Hopefully we'll have him on soon, though. Here's the thing. He's right, but he didn't need 5 reasons to be right. His first reason is really the only thing we need to discuss. While the other 4 are interesting and also correct, his first reason is all the evidence we need to predict a rate hike in 2021. Before we get to the why, David points out another interesting point and prediction. Mortgage originations will probably wrap up in the $3 trillion mark for 2020. An insane number, big enough for pretty much every relevant mortgage company to have a record year in 2020. Now, 2021 may be a different story. All indications point to a $800 billion reduction in originations. Let's nerd out with the MBA forecast, and we'll see that originations are dropping from $3 trillion in 2020 to $2.1 trillion in 2021. Where will the reduction come from, you might ask? That's pretty obvious. Refis, right? Refis are slated to drop from $1.6 trillion down to only $710 billion. Over a 50% reduction in fewer refis next year. LOs plan accordingly. Good news is purchase business is projected to increase from $1.3 trillion to $1.4 trillion. The MBA forecast for rates isn't a huge increase. They are predicting rates will rise slightly from 3.1% to 3.3%. Now, Stevens doesn't make a rate prediction in the article, but I wouldn't be surprised if rates finish the 2021 calendar year a little bit higher than 3.3%, which is the MBA prediction. But back to why Stevens is right with his first reason in the article. Stevens talks about the Fed's involvement in the mortgage-backed security market and how and why rates have stayed low. And no, it's not because the Federal Reserve lowered short-term rates or because Trump waved a magic wand. It's mainly because the Federal Reserve is the single biggest buyer of agency mortgage-backed securities in the world. Case in point, the Fed spent almost $300 billion in agency mortgage-backed securities in March alone, and another $300 billion in April. Now, after the market stabilized, the Fed slowed its purchases to around $100 billion per month in May, June, and July. I mean, the Fed's only purchased $104 billion in July. Here's his closing statement on his main point. The question is, what happens after a COVID vaccine and a normalization of economic activity, which is expected next year? The Fed is already being very careful not to commit to mortgage-backed security purchases after the end of the year. If the Fed continues to slow or stop something, which is probably going to happen, the supply of imbalance will force rates higher as mortgage-backed security prices drop and search for buyers to make up the excess. In short, if the Fed hadn't been spending anywhere from $100 to $300 billion a month on mortgage-backed securities, our rates would be much, much higher. If and when the Fed stop making it rain and they wind down their mortgage-backed security spend, we'll see a void that was previously plugged by the Fed, and I don't think that there's enough actual mortgage-backed security buyers to make up for the Fed void, which will push rates higher. How high? We don't know yet, but higher. I hope that makes sense, and I know that's a little bit technical with some crazy acronyms. I'm really hoping to get David Stevens on the show so we can discuss further and unpack this topic even more. Hey, to be fair, his other reasons are right. I just think he needed just the one, though, like done and done after the Fed, like he sold me. But here are the other reasons Stevens believes rates are rising: the national debt, the GSE capital rule, the adverse market fee, and finally, the release from conservatorship. Which, call me a mortgage nerd, that would be a really, really good podcast with David Stevens, Brian Stevens, Barry, and myself. Anyways, share today's show, guys. Loan officers and realtors, you gotta share it. Your clients need to hear this stuff, and we'll see you guys next week.